You've probably heard the news. SVP, Silicon Valley Bank, the 16th largest bank in the US, is failing. Now, before you lose all your money, run to the bank right now, take out all your money, and hide it underneath your mattress. No, stop. Don't do that. While SVP is the largest bank run in over 10 years, that doesn't mean the economy is about to crash. This isn't 2008, your money is safe. The news exists to freak you out, to exaggerate what's going on so that you'll watch. That's how they make money. And so now that most of the dust has settled, I wanted to take some time to walk through what happened and how it impacts you. First, how does the banking system work? The basic idea is the banks take on deposits from their customers and then they lend that money out to other customers for profit. The money that you deposit doesn't just sit in a bank account. For example, if you deposited $1,000 today into a bank account, the bank would probably keep a percentage of that, usually about 10%, and the rest they would lend out. And when they're lending it out, that looks like a mortgage, a line of credit, credit cards, and even sometimes they'll lend it out to the government in the form of bonds. So when you deposit $1,000 into the bank, you've only really got $100 in there. The remaining 900 they've lent out to make money off of. And this is what we call a fractional reserve banking system. Now, usually this isn't an issue because not everyone's going to go and run out to the bank at the same time to try and take money out. The issue arises when there's more people trying to take money out than the bank actually has in reserves. And that's precisely what happened at Silicon Valley Bank. Now, before we go into detail on what happened at Silicon Valley Bank, be sure to subscribe to the channel, like this video. It really helps and I really appreciate it. So Silicon Valley Bank is based out of California in Silicon Valley, and it primarily serves the tech sector. In fact, it's the go-to bank for many funder-backed companies in the valley. And so during the pandemic, as interest rates went down and tech companies boomed, deposits boomed as well. And this was great news for SVP, and what they did was what any bank would do. They went out and bought bonds with those deposits. But then in 2002, interest rates started to go up, and that impacted tech stocks because their valuations started to decrease. And then it became really difficult for these companies, these startups, to raise additional money. And so these companies started to deposit less and less money into SVP. But not only that, because it became difficult for these companies to raise additional money, they had to go back to their bank accounts and start taking money out so that they could continue to pay for their everyday operations, for example, like payroll. But that's not all. Since interest rates were going up, the value of those bonds were going down. The reason is that when the bank originally bought those bonds, interest rates were a lot lower. Since interest rates went up, the value of those bonds decreased. And the reason is because if you own a 2-year bond that's paying, let's say, 2%, why would you buy that when you can buy a bond that's paying 5%? Right. And so the value of that bond, the price has to come down to make it more appealing for investors to buy into. And now because SVP is running out of money in reserves, they have to sell these bonds. And because the value of those bonds has decreased, even by selling them, they don't have enough money in reserves. So now SVP is running out of money. Their reserves are going down really fast. What do they decide to do? They're like, okay, let's raise some money from private equity. And when people found out, this caused panic in the stock market. The price of SVP stock went down, and venture capitalists started to instruct companies that they had invested in that they knew had deposits with SVP to go and take their money out. And Peter Thiel, who's super popular in the venture capital space, who has backed a lot of companies, was one of those who was especially vocal. He called up all his companies and was like, hey, take your money out right now. And then it made it to social media and it was all over Twitter, and everyone who banked with SVP was running to try and take their money out. And that's one aspect that really isn't talked about much in the media, is the role that social media played. It was all over Twitter that this bank is failing and that you need to go out there and take your deposits now. And that's a classic example of a bank run and what caused SVP to collapse. And this could have happened to any bank. No bank is immune to a bank run. What's unique in this situation is that how specialized SVP was for tech companies. And the environment that we're in right now, interest rates are going up, that impacts tech companies. Tech companies are having a more difficult time raising money, and so they have to go back to the cash in their bank accounts. And because of that, the bonds that SVP invested in, their value went down. So when these tech companies are going to withdraw money, the bank has to sell bonds to have the cash to give to them. But because interest rates were going up, the value of those bonds went down as well. Add in some panic that the bank's running out of money and that they need to raise money through a private equity firm, throw it up on social media and Twitter, and all of a sudden you've got a bank run. And the one thing about Silicon Valley is that they tend to operate with a herd mentality. We see that when new ideas come out, everyone goes after it. For example, AI. everyone gets excited about it and it causes bubbles. And then on the flip side, when there's panic, everyone panics at the same time. So within a few days of the bank almost collapsing, that's when the FDIC steps in. The FDIC is the Federal Deposits Insurance Corporation, and they insure up to $250,000 of cash deposited in banks. To date, when a bank has failed, everyone's still gotten their money back. And even if you had more than $250,000 that is said to be insured, even in those situations, people have gotten their money back. And one thing to keep in mind, when these people have gotten their money back, it's not being paid for by taxpayers. In fact, the FDIC is an insurance corporation that banks pay into for situations like this. And another reason why your money is safe is because money and banks and the government itself all run on trust and confidence. In fact, if you take a look at the US dollar, it's essentially worthless paper. And when you take a look at legal dollars, it basically says that it's backed by the full faith and credit of the US government. So if a bank fails and you were to lose your money, first, the entire government of the United States would have to fail.
If the central bank collapses in America, you need bullets.
And so when you're thinking back about what happened at SVP, it wasn't fraud, but a black swan event, a series of unfortunate events. If they had a more diverse customer base and didn't focus just on Silicon Valley tech startups, maybe they would have been okay. Could they have done a better job of managing their interest rate risk if they were putting so much money into bonds? Had they accounted for what would happen if bond rates went up? Maybe they could have done a better job with that. So given all this, what can we learn? First of all, your money is safe. This isn't systemic risk. There isn't a banking problem or a credit problem. Your money is safe. Even Dave Ramsey is not worried about the banking system.
Your bank is safe. Calm your butt down.
And the other thing is, with all of this, the good thing is bond rates came down. So if you're looking to get a mortgage right now, this is actually a really good time to do that. And in situations like this, it reinforces the fact that you need to be investing in real assets, whether that's stocks or real estate. And that's what I'm doing. And as we're going through this, it reminds me of something that Scott Galloway says a lot, that nothing is as good or bad as it seems. And I think even if, as we're going through this turmoil in the economy right now, we started with inflation, then interest rates, now this banking crisis and potentially unemployment down the line as well, I think we've got to keep in mind the bigger picture. Nothing is as good or bad as it seems. There's always something that you can do, actions that you can take, and the economy has never been stronger, in my opinion. So continue to take action, take steps one step at a time, whether that's growing your business, investing in stocks, or buying real estate. All right, that's it for now. I hope you enjoyed this video. Be sure to like and subscribe, and I will see you next week.